Introduction of Continuous Time Finance Book Summary. Ever wondered how math rules the world of money? In this book summary, you will learn how mathematical models shape the financial decisions we make every day. Discover how simple math ideas power complex tools that help decide how much to save, invest, or spend. You'll see how these models predict market changes, manage risks, and guide choices in uncertain times. Learn how companies and individuals use these models to plan for the future, from setting up retirement funds to designing insurance policies. This summary breaks down how math keeps modern finance running smoothly and why it matters for everyone. Listen till the end of the book summary. This video, including its audio and script, is protected by copyright. Unauthorized reproduction, distribution, or piracy is strictly prohibited and may result in legal action. Welcome to Economics English Book Summary, Episode 4. In this episode, we'll explore 1990 published book Continuous Time Finance, written by Robert C Merton. The full title of the book is Continuous Time Finance, Mastering Financial Strategies with Math, Models, and Insights. Chapter 1 of Continuous Time Finance Book Summary. Modern Finance Uncovered. Step into a world where money moves fast and every second counts. In this part, we explore the ideas behind modern finance and continuous time models. Imagine a market where prices change in a blink of an eye. Decisions must be made quickly. These models help us see how money flows and changes over time. They give us a clear picture of a busy financial world. The models ask two big questions. First, how should we use our money over time? Second, how does risk affect our choices? The math behind these ideas may seem hard at first. It helps us handle random events and unexpected changes. In the market, things like interest rates and asset prices never stop moving. Continuous time models capture these changes very well. These ideas are useful for everyone. Consider a household planning how much to spend today and save for tomorrow. This simple plan is made clearer with these models. Businesses also use these tools. They decide where to invest and how to manage risks. Markets are where buyers and sellers come together. Stocks, bonds, and options are traded every day. Continuous time models show us how these prices are set by supply, demand, and risk. These models also help in keeping risks under control. They guide experts on how much exposure there is to uncertainty. This way, smart plans can be made to protect against loss. By linking math with everyday choices, these models make a complicated world easier to understand. They reveal how people and companies make decisions in a market that never stops moving. Stick with us to uncover more secrets on how modern finance works and how these ideas can help in real life. Chapter 2 of Continuous Time Finance Book Summary. Smart Money Choices. Imagine planning your future while keeping up with life's unexpected turns. How do you decide what to spend today and what to save for tomorrow? Continuous time finance helps us answer this. It uses simple math to guide us through uncertain times. The main idea here is the lifetime consumption and portfolio selection problem. This means figuring out how to split your money between spending now and investing for the future. The goal is to get the most satisfaction or utility from your choices over your whole life. Utility functions help us understand this balance. They show how we choose between enjoying money now and saving it for later. Some models assume that a person's risk tolerance stays the same no matter how much money they have. This is called constant relative risk aversion. It helps simplify the complex decisions we face. Continuous time models break down these choices into small, manageable steps. One key tool they use is stochastic dynamic programming. This method takes a big decision and turns it into many small ones. Another important part is the budget equation. It makes sure that spending and investing do not exceed what you have. This idea fits with the life cycle hypothesis. The hypothesis suggests that people try to even out their spending over their lifetime. Whether you are working or retired, the model helps decide how much to consume and how much to save. Real life is never simple, so the model can also include extra factors like uncertain lifespans. These additions make the plan more realistic. In the end, continuous time finance gives us a clear way to make smart money choices. It combines math with real life needs, helping you navigate financial challenges with confidence. Chapter 3 of Continuous Time Finance Book Summary. Trading Tools Explained. Imagine holding a tool that can predict market twists and turns. Options and warrants are such tools in modern finance. They help traders manage risk and bet on future market moves. These instruments get their value from a base asset, like a stock. Their prices depend on how uncertain the market is and how it behaves. An option gives its owner the right, but not the duty, to buy or sell an asset at a set price within a certain time. Warrants work in a similar way. They are usually issued by companies and often last longer than options. Getting their prices right is key. Accurate pricing stops traders from taking unfair advantage, keeping the market balanced. The Black-Scholes model changed the game. It brought a simple formula to price European-style options, which can only be used at expiration. The model assumes constant trading and no extra costs. It works by tracking a portfolio that mimics the options payoff. The portfolio combines the underlying asset and safe investments. Adjusting these parts leads to a fair price that matches market demand. Continuous time models allow us to expand on these ideas. They can handle options where stock prices jump instead of moving smoothly. They also work with exotic options that have unique rules. These additions make the models useful for real-world finance. The impact of these pricing ideas goes far beyond textbooks. Derivatives markets around the world rely on them for fair pricing. Companies use these models to check investments and design employee rewards. Industries like insurance and commodities also benefit by measuring and managing risk. By mixing simple math with market rules, warrant and option pricing theory supports market stability. It shows how continuous time models can tackle even the most complex financial challenges. Chapter 4 of Continuous Time Finance Book Summary. Finance Unlocked? Imagine a company deciding how to pay for its projects and grow its business. How does it choose between borrowing money or selling shares? Corporate finance digs deep into these questions. One key idea is the Modigliani-Miller theorem. It tells us that in a perfect world without extra costs, a company's value stays the same, no matter how it is financed. This may seem strange, but it lays a foundation for modern finance. Building on this idea, contingent claims analysis (CCA) comes into play. CCA uses simple math, from option pricing to value corporate securities. For example, you can think of a company's debt as a mix of risk-free debt and an option held by shareholders. This view helps us measure a company's obligations, especially when things are uncertain. The approach also uses dynamic portfolio theory. This theory shows how companies can balance their assets and liabilities over time. By treating securities as claims that depend on outcomes like stock prices, CCA goes beyond older methods. It becomes very useful for pricing corporate bonds, checking the risk of default, and understanding how financial moves affect a company's worth. CCA has many real-world uses. Companies rely on it to decide the cost of borrowing and the best mix of debt and equity. It even helps during tough times by guiding how assets should be divided among creditors and shareholders in financial distress. For investors, CCA offers clear insights into the risk and rewards of corporate securities, making it easier to decide where to put money. By linking corporate finance with simple math tools, this method gives businesses and investors a clear guide through uncertainty. It shows how modern finance tools can simplify complex decisions, making risk and value much more understandable. Chapter 5 of Continuous Time Finance Book Summary. Market Moves. Imagine a world where every decision today shapes tomorrow's market. Think about how the choices you make can affect your investments over time. This is the idea behind intertemporal equilibrium and capital asset pricing. In financial markets, prices change to balance risk and reward. The intertemporal capital asset pricing model, or ICAPM, helps us see these changes. ICAPM builds on the classic capital asset pricing model. It links an asset's expected return to its risk relative to the market. But ICAPM goes further. It introduces the security market hyperplane. This is a simple way to show how different risks impact asset prices. Risks include market swings, changes in interest rates, and shifts in the economy. With these ideas, the model gives us a clearer picture of asset pricing over time. Another tool is the consumption-based capital asset pricing model, or CCAPM. This model was introduced by Douglas Breeden. CCAPM ties expected returns directly to changes in consumption. It shows how our choices to spend today affect our future returns. This connection makes finance feel more relevant to everyday life. These models are not just theories, they have real uses for investors and policymakers. Investment managers use ICAPM and CCAPM to build portfolios that balance risk and reward. They look for assets that do well under certain economic conditions. This helps create strategies that can survive market ups and downs. Policymakers also gain insights into how financial markets reach equilibrium. By linking time, risk, and economic factors, these models help us understand the complex world of finance. They turn abstract ideas into practical tools for smart investing. Stay tuned as we dive deeper into how these models work and how they can guide your investment choices. Chapter 6 of Continuous Time Finance Book Summary. Smart Finance. Imagine a government planning for the future while juggling risks and resources. Public finance faces big challenges every day. It must manage money for society, protect against financial surprises, and plan for uncertain times. Continuous time models have become key in this work. These models help design better public pension plans. Traditional pensions adjust for inflation, but that only fixes part of the problem. A stronger plan uses consumption index benefits. This means benefits change with economic conditions, so retirees can keep their standard of living. Continuous time models calculate the best contribution rates and benefits. They balance today's costs with tomorrow's needs. Another important use is in loan guarantees and deposit insurance. For example, the Federal Deposit Insurance Corporation protects deposits up to a certain amount. This safety net reduces risks for people and keeps banks steady. Pricing these guarantees is tough because they depend on future events like bank defaults. Here, continuous time models borrow ideas from option pricing. They help policymakers estimate the true cost even when market prices are not clear. These tools also offer insight into long-term growth. They show how ignoring changes in technology or population can lead to mistakes in planning. By including randomness, the models make forecasts more accurate. They guide strategies that manage risks for many years ahead. The impact of these models goes far. They improve how public programs work. They help keep our financial system stable. They guide governments in sharing resources wisely. With these tools, policymakers can create plans that adjust to changing economic times. This not only strengthens public programs, but also benefits society as a whole. Conclusion of Continuous Time Finance Book Summary. Thank you for watching this book summary of Continuous Time Finance by Robert C Merton. Today, you learned how continuous time models can make the confusing parts of financial markets easier to understand. These models help people, businesses, and even decision makers plan better by handling risks and uncertainty in a simple way. We talked about how these ideas can help in everyday choices like spending, investing, and even pricing options and corporate securities. With a clear framework in hand, you now know how to look at risks and manage resources more wisely. This approach gives you the tools to make smarter choices when things seem complicated. We hope this summary made the ideas behind continuous time finance easy to follow and useful for your own decisions. Thank you for staying with us through the whole summary. If you enjoyed the video, please leave us a rating. Your feedback really helps. Listen to the other book summary. Disclaimer, please check the description. Any digital copy of this content that is shared through piracy or downloaded without permission or uploaded on any online social media platform will be considered a clear violation of copyright law. Piracy is a serious offense and strict legal action will be taken against it. Additionally, copyright infringement may result in a strike against your YouTube channel or page, and it could even be deleted. Therefore, please do not engage in piracy or support it. This content has been created based on the references from the mentioned book. However, it may contain some unintentional errors or inconsistencies due to human or mechanical mistakes. If you notice any mistakes or inconsistencies, please accept our apologies and inform us through a comment or message. If you enjoy this book summary and wish to gain complete knowledge of the book, then please consider purchasing the book from an online or offline bookstore and reading it. Thank you.